Oh my God, this is one of the most important videos for your SBR success. I've been teaching SBR for over 12 years already, even before it was SBR. And the question that I get a lot is, when definitions score marks in ACCA SBR, and do they actually score marks or not? So let's deal with that. I'm going to give you examples when we have to use the definitions, and I will also give you the breakdown by standards. So, do definitions score marks in ACCA SBR? The answer is yes and no. So this means that ACCA wants you to be very useful to your client. And imagine if you go to a doctor and the doctor just gives you a printout from Wikipedia or from ChatGPT, you would not be happy, right? The same idea is in here. If you have a question and you just bombard your client with the definitions with excerpts from the standard, this is not an application, this is not a mark. But we do get marks when the definition moves us closer to the answer, when you are going to use the definition to justify your point. So there are certain cases when definition is a must. The first example of that would be something is not something. Let me give you an example from a real question that we had a couple of years ago. Discuss briefly. Briefly means that it's 1 or 2 marks, or usually in here we have 4 marks. Why the right to receive access to Sitka software is unlikely, so not, to be accounted for as an intangible asset or a lease in some companies' financial statements. If you are just going to say that, oh, it won't be accounted for because it has to be expensed, this is 0 marks. The question specifically asks you to explain why it is not an intangible asset, why it is not a lease, which means that you are going to give a definition that intangible asset is non-monetary, blah, blah, blah. And then you are going to challenge each and every part of that very definition in order to get a mark. The same idea for a lease. You're going to say that lease is an agreement that takes right of use asset. You're going to give a definition of right of use asset, and you are going to explain that this is not one. Another example would be when a question is something or something else. And this is a super typical question. It has been tested many times. It will be tested. The chances of it being tested in question 2, something like 50%, maybe more. So, discuss whether Class A and Class B shares should be classified as either equity or liability in accordance with IAS 32 financial instruments. So in this case, again, we would need the definition, mainly in here, we would need a definition of a financial liability, and we would go alongside the provisions of that very definition, and that is how we score 5 marks. The next very important part is the conceptual framework questions, which are aimed at the definition of assets, liabilities, equity, income, and expenses, most likely assets. The directors of jury require advice why internally generated brand can't be recognized as an asset. In this case, you will need to give a definition of an asset. So it's past events, that this is controlled by an entity, and so on. And you would need to challenge that together with the 2 fundamental qualitative characteristics. If you just are going to say that internally generated brand is strictly prohibited by IAS 38 itself, then it's just 1 mark. But most likely this question is going to be for something like 5 to 6 marks. So for you to get a mark, you need a definition of an asset that comes from the conceptual framework. Oh my! This SBR Made Easy podcast is fantastic because it's not just about the theory, it is about the application. And if that is what you get for free, just imagine how fantastic the course is. Enroll to pass the upcoming session. Let's continue watching. Let's go. So which standards are tested the most frequently? First of all, IAS 32. This standard is the king of question 2. It's really tested, well, maybe in every second session. And for that, you would need a definition of a financial liability. Not all of it. Well, so we need basically 3 main provisions. So I'm going to give you a shortened version. A financial liability is supposed to be a contractual obligation. So when you are going to challenge whether this is a financial liability or not, you're going to see if there is a contract between 2 parties. Spoiler alert, when we are talking about Bitcoins, which is looks like a financial asset, it's not a financial asset because there is no contract between 2 parties. To deliver cash or another financial asset to another entity. So this means that you are going to look at the blah, 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 at the description of what those preference shares or any other instrument like initial coin offering offers to the investor. You are going to look at something that happens annually, like dividends, and you are going to say whether there is an obligation, unavoidable obligation to deliver cash or another financial asset, or whether it is not. Or a contract that may or will be settled in the entity's own equity instrument and is non-derivative, for which the entity is or may be obliged to deliver a variable number of entities' own equity instruments. So we are going to look at that very contract, and if the contract says that the company will give its own shares, like Facebook will give Facebook shares, not Amazon shares, and it's variable number, so this means shares worth, let's say, 3 million and not 3 million shares, then in this case it's going to be a financial liability. That is how you're going to apply it. That is how you're going to score most likely 2 to 3 marks, and it will give you the ground to talk about ethical principles. So make sure that you remember it by heart, the most important definition in your whole syllabus. The next thing that we need is IFRS 13 fair value measurement. It's never tested or not so regularly tested as a separate question, but it is very often tested in conjunction with other standards. Fair value is the price that would be received to sell an asset or paid to transfer liability in an orderly transaction between market participants and the measurement date. This is an extract from IFRS 13 itself, right? And with this very example, I will also show you how to study the definitions so that you will be able to score marks later. When you study definitions, it's not about explaining the idea of fair value in this very case. It is about identifying key components that have to be true in order for that to satisfy the definition. So let's have a look. Let's have a look at those logical arguments. Fair value is the price, okay, and that would be received to sell an asset paid or transfer liability, okay, nothing specific, in an orderly transaction between market participants at the measurement day. So basically, I look at the adjectives. Adjectives is something like big, small, orderly, market, measurement. This is adjective like description. These are the 3 key adjectives that I need to remember. If I were to make a mind map, I would do it like that. I would say fair value and I would say orderly. Then I would say that it's market participant. And I would say that this is measurement date. And that is what I would challenge. Okay, is the transaction orderly? Oh, maybe not, because this is a transaction with our main supplier and we get that very item in exchange for the fact that we are going to buy something from them. Okay, is it between market participants? No, because it's between us and our subsidiary, us and our associate, and we're not market participants. We are related parties. Is it at the measurement date or half a year ago? Oh, it has happened half a year ago, so it can't be used as a fair value. Have you made sure that you subscribe to this channel? Do it now. The next standard, IAS 7, cash and cash equivalents. Tested quite regularly in question 2, can be tested in question 1 if you are getting tested on the cash flow statement. Cash equivalents, and in here I looked at the standard, I looked at the definition, and now I'm giving you those key logical arguments. Short-term, highly liquid, readily convertible to cash, insignificant risk of changes in value. This is your definition. Short term, meaning not, let's say, for a year. Highly liquid, which means that there is an active market. Readily convertible to cash, insignificant risk of changes in value, so shares won't satisfy the definition of cash equivalents. Then, the next batch of questions is the questions that are associated with our consolidation questions. And when people move from the FR exam to SBR exam, quite often they forget that we also need to learn how to discuss stuff. So they focus on goodwill, they focus on impairment, leaving this definition of control, definition of a business, and other SBR intensive questions, and just not studying them. You have a set of videos in my course about SBR style question, discursive question on consolidation. Make sure that you watch that chapter. So, definition of control. Power over investee, exposure or rights to variable returns, ability to use power to affect those returns. What does it mean? Well, we would need to explain why is that we think that we have power over investee. So why do we have exposure or rights to variable returns? If that very investment of ours does not give us the ability to get sometimes this much, sometimes that much, does not mean that we have control. So, for example, if there is a contract with other parties that despite the fact that we have 60% of rights, we will be able to get from this very investee only, let's say, 1 million annually, then in this case, we don't have exposure or rights to variable returns. The ability to use the power to affect those returns by exercising power. Do we get the seats at the board? Can we vote against something or vote for something at our general shareholders meeting? We will apply the definition to decide whether indeed this is going to be a subsidiary or not, whether it's us who is the acquirer or the other party who is the acquirer. These questions are quite typical as question 1. Make sure you study them. Another question that is tested very frequently as question 1, and usually it's a mess when students try to attempt it, it's business definition. So for example, I'm buying a company and the company has just one asset, which is a building that it leases out. The question is whether I bought a business or whether I just bought a building that was organized legally as a business. And you remember substance over form, right? So we have a definition of a business that it consists of inputs, processes that apply to those inputs, and it creates outputs. Outputs do not necessarily have to be, but we need to make sure that there are inputs and processes. And the definition of a business is that there is an integrated set of activities. So something has to be happening. Don't really matter whether those employees are actually our employees or they are outsourced, but it has to be a set of activities. There have to be some assets that are capable of being used as part of those activities in order to generate return. The conceptual framework, the definition of an asset. It's a present economic resource, so we have to have something controlled by the entity as a result of past events. So for example, when we're talking about internally generated brand, has it happened as a result of past events? Oh yes, it has happened because we spent money on marketing so that people would know about our company. Is it an economic resource? Yes, it is an economic resource. Because of this internally generated brand, we will be able to charge higher prices or get more clients. Is it controlled by the entity? Yes, it is controlled by the entity because we are legally protected from anybody else to benefit from our brand name, like let's say Coca-Cola. So according to the conceptual framework, it meets the definition of an asset. So theoretically, it has to be recognized. But and make sure that when we apply the conceptual framework, we also remember about the 2 fundamental qualitative characteristics, which is relevance. And we say, yes, it is relevant because users of the financial statements would like to see the information about it because it shows them how much value their investee is going to bring. And also whether it can be measured faithfully, faithful measurement. And in this case, we have a problem because it's impossible to separate the effort from building long-term brand value from short-term sales promotion. So for example, if we run this fantastic Coca-Cola Christmas commercial, will it allow us just to sell Coca-Cola around the Christmas time? Or will we be able to increase the brand awareness so we can't separate those two events between each other? That's why we don't recognize entirely generated brand. And also because IAS 38 strictly prohibits it. The next definition that is tested very often, it's lease versus service. So the question is whether we need to bother and recognize right of use asset and financial liability, which means gearing is going to look much worse. And this means that it is a candidate for question 2. So you need to know this very part of the theory, or we just expense it. So you need to have remember the definition that lease is a contract, a part of a contract that conveys the right to use an underlying asset. There has to be an asset. So if you are, let's say, renting this very car, then this car is an asset. So this is going to be a lease contract. If you are renting something from, let's say, Hertz or Europe Car or whatever, and they can give you any car, they bring it in the morning, and there is no underlying asset. So this is going to be a service and it's going to be expensed. Period of time, exchange of consideration. So you need to also know the definition of right of use asset. With the right of use asset, we need to know right of use definition. And this is to substantially get all identified assets, economic benefits, and the right to direct identified assets use. With this very case, we will be given a mark for definition because we will later take the scenario and challenge it. Like, does this mean that we get the majority of the benefits? Does this mean that we get the majority of benefits? Does this mean that we can direct or cannot direct? Is it our inability to direct the use or just this limitation of scope? So important to remember. Then, IFRS 8 operating segment. Many people ignore it. IFRS 8 is tested very, very frequently. So operating segment is a component that engages in business activities from which it may earn revenues and incur expenses. So this means it's not head office because head office does not earn revenue. So this is not operating segment. Whose operating results are regularly reviewed by the entity chief operating decision maker to make decisions about resources to be allocated to the segment and assess its performance. So it has to be something like a management report that is going to be used later. This means that we can't just look at the numbers and say, oh, let's organize it like that. No, we actually need to use the breakdown that the management uses, and for which there is a discrete financial information available, but usually there is financial information available because IFRS 8 is obligatory for those companies that have a traded debt or listed, and this means that by that time they have good corporate governance, which means that they have financial information. So study the definition of IFRS 8 operating segment. Intangible asset is identifiable, so it has to be separable, it has to come from legal rights. That's why we have goodwill at the point of business combination of the purchase of a subsidiary, because there always will be a number of assets that we can't identify separately. So goodwill is this basket of unknown goods. Non-monetary, so this means that it does not lead to cash. Asset without physical substance, so it can have some physical substance, some physical form like a flash drive, but it's immaterial. Such an asset is identifiable when it is separable or when it arises from contractual or legal rights. So that is something that is tested when we are asked to discuss whether it's an intangible asset or a service. So for example, if you sell software, access to something, is it that you're selling intangible asset, or is it that and you're transferring it, or is it just a service? And these are the main definitions that you need to remember. And of course, in my course, you do have it with those breakdowns, with those highlights to the most important points and how they are going to be tested, and quizzes that make sure that you comprehend the information correctly. So make sure that if you want to pass SBR, you join my course, or at least join study groups that also have 3 weeks every once in a while. So make sure to subscribe to the next event, and you can access it on my website. This was Lilia Kirilenko, SBR Made Easy podcast. Thank you for joining my course if you are going to, and I will see you next. Bye.